Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. We all know that inflation is running sky high these days. Looking at the prices of usual things that we buy, such as groceries, clothes, furniture, we can see that almost everything costs way more than a year ago. Inflation in the United States is touching over 8%, while that in Europe is touching 9 or 10%. If you were born in the 80s or 90s, you may never have seen such price increases in such short time periods. Looking at the situation, many investors are thinking, how does inflation impact stocks and their performance? So, in this video, let's have a look at different ways in which inflation can impact stock prices and performance. Before we start, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos. Let's continue. Let's start with what is inflation. If you're wondering what inflation exactly is, here is how Sam Ewing, a former baseball player from Chicago White Sox, put it. Inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair. Jokes aside, inflation is a general increase in the prices of goods and services in an economy. When the general price level rises, each unit of currency buys fewer goods and services. Consequently, inflation corresponds to a reduction in the purchasing power of money. Inflation is mainly measured using Consumer Price Index, or CPI. CPI tracks the prices of around 8 major categories of goods and services: food and beverages, housing, apparel, transportation, medical costs, etc. Now let's understand what causes inflation. There are two primary reasons behind an increase in the inflation rate in an economy. Number one, demand is greater than supply, or supply is less than demand. There are times when the average income of people in an economy increases and they may want to buy more products and services. During such times, the demand can increase above the supply of the said products and services. Hence, there is scarcity of goods and services that causes buyers to pay more for them. This eventually results in a general increase in prices. Second, increase in the cost of production or cost of supply. The inflation rate also increases if the cost of production of goods or cost of supply of these goods increases due to an increase in the costs of raw materials, manpower, taxes, or higher costs of shipping and transporting these goods. While this leads to an increase in the cost of production and transportation, it also causes a drop in the supply of the said goods. With the demand remaining the same, the price levels tend to increase. The current inflation is more in the second category, where inflation is driven more from supply-side constraints versus being driven by a major increase in demand. Now let's look at how inflation impacts investors and their investments, such as stock ownerships. According to the legendary investor Warren Buffett, inflation swindles almost everyone. It does not matter whether you're holding cash or stocks or government bonds. There are two key factors influencing stock prices. First is the fundamentals of the company, its cash flows, its growth, capital allocation, revenues, margins, etc. Second is the behavior of investors and traders that are buying and selling the stocks. Inflation impacts both these factors. Here are three ways in which inflation impacts stock prices and performance. Number one, purchasing power. As inflation goes up, purchasing power of investors and traders goes down. They have less cash to save and therefore less cash to buy or trade stocks. This has a direct effect on the stock prices. Number two, interest rates. As inflation goes up, central banks will typically increase interest rates. The idea is to incentivize people to save money and curb excessive liquidity, bringing the inflation rate down. And if people save the money in the bank, they would like higher interest on it if inflation remains high. So this helps people to not lose too much value of their cash. But the same policy has a downside for companies, as the loans and debt gets costlier too. The cost of capital for companies increases. Hence, the projected cash flows are valued lower, resulting in lower valuations, particularly for companies that don't have much of a cash flow today and are expected to generate more cash flow far in the future. These are mostly growth companies such as Carvana, Roblox, etc. Third, volatility. As the inflation rates rise, speculation about the future prices of goods and services leads to a market environment that is highly volatile. Since prices are rising, many investors will speculate that companies will experience a drop in profitability. Hence, some investors might decide to sell the shares, leading to a drop in their market price. At the same time, investors optimistic about the company making profits in the future might buy these stocks, causing a volatile environment. Value stocks versus growth stocks versus dividend stocks. Value stocks are strongly impacted by a change in the rate of inflation. The market price of value stocks is usually directly proportional to the rate of inflation. Therefore, when the inflation rate rises, value stocks tend to perform better. On the other hand, growth stocks have minimal cash flows. Therefore, they have a negative correlation with the rate of inflation. The market price of these stocks drops when inflation rates rise. Lastly, if you look at dividend-paying stocks, then an increase in the rate of inflation can cause a drop in their market price too. This is because with rising inflation rates, dividend yields can fail to beat inflation, making such stocks less attractive to investors. Long-term benefits of moderate inflation. Inflation is not the devil that it is assumed to be. In fact, a controlled rise in inflation rates is a sign of a growing economy. If you turn the pages of history, you will find that on most occasions, a rising inflation rate is synonymous with an improvement in the gross domestic product or GDP. It is important to remember that if inflation rates are too high, then purchasing powers can erode drastically, creating havoc in the economy. However, if the inflation rates are too low, then the growth of the economy can get stunted. Therefore, investors must compare inflation rates in the recent years to assess if the increase is sudden or sustained. If the inflation rates are rising steadily, then it can be healthy for businesses and the economy and be a good environment for stocks. Final views. Summing it all up, long-term investors must consider the fact that governments constantly take measures to keep inflation in balance. And so, during rising inflation times, investors must avoid panicking and emotion-based decisions and look for fundamentally strong stocks that can weather any economic storms, such as Apple, Alphabet, Amazon, etc. For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive follow-up videos. Thanks for watching.